Marco Stalt from ADM Investor Services International with some thoughts this week on the latest OECD economic forecasts and a little bit of a look at what's been going on in China in terms of FX bond and equity flows. So the OECD economic forecasts saw a marginal increase to forecasts for global GDP in 2021 to 5.8 from 5.6, with it being quite emphatic that who will be leading the way. India at 9.9, that's considerably lower than originally anticipated, which was 12.5, but still very strong. China with a strong contribution at 8.5, the US upgraded to 6.9, the UK to 7.2, strong contributions also from Australia and Canada, and the Eurozone growing a steady 4.4 this year and 4.3 next year, perhaps more important next year forecast because it shows that there's some delay due to all the activity restrictions which have been in place for much of 2021. But I think the key aspect of all of this really is to understand proportions, because as much as we may celebrate the likes of the UK, Canada, Australia growing strongly, really at the end of the day, when you look at actual shares of global GDP, the UK is just 2.3. Australia is just 1% and Canada 1.4, whereas China represents 18.3, the US 15.9, the Eurozone 15.4. Japan's 4%, which is expected to be quite sluggish. And then you have the likes of Turkey, which is indeed stronger than either Canada or Australia at 1.9, and Russia at 3.1. A lot of this is really about the growth in EM combining with the major economies and the Eurozone in the developed world. So how does that look in the context of rate outlooks? Next table is a familiar one, market implied policy rates. I think the important thing here is to note that we're still looking at a fairly flat trajectory for most economies, at least for the next 2 years. In 3 years' time, there are anticipations of a small rise in interest rates, very modest. The big risk at the moment really is the smaller economies where you get some outliers stealing a march on the rest. In Europe, that would be the Czech Republic, Norway, Poland. More interestingly, in Asia and Latin America, we're talking about very sharp rises in Brazil, also relatively sharp rises in both India and China, and to a certain extent, South Korea. Given all of that, you would have thought that the emerging market FX world would be actually doing a little bit better. My third chart is the JP Morgan Emerging Market Foreign Exchange Index. And I think really the very simple point in this is as much as China as currency has been doing well, which I'll come to in a moment, emerging market currencies haven't been doing particularly well. True, the likes of Turkey, Russia, and Brazil have not helped that, but it does really emphasize that if we are having an EM FX rally, it's very modest at best so far. Contrast that with China, which is the CNY CFETS index. And I think the interesting aspect following the decision to raise margin requirements on foreign banks FX trading to 7% from 5% last weekend is one can see exactly why from this chart, that the CFETS index is basically at its prior high from 5 or 6 years ago. And that underlines the extent of the pressure there. How does that look in actual capital flow terms? Well, the final two charts I think are interesting. The first one is foreign holdings of Chinese debt and equities. As one can see, the equity inflows and the bond inflows have been very, very strong during 2020. Less so this year. 2021 seen a little bit of an outflow out of equities, but continued demand for bonds, underlining reach for yield in so-called relatively safe assets. Contrast that, I think, with the domestic aspect, which is margin debt in China. And I think the interesting aspect here is there's no clampdown as such yet, even though margin debt has been rising and has certainly helped the modest recovery after tailing off in the Chinese equity index. But that's something which we'll definitely have to watch very, very closely. And it may be another area where China might seek to intervene. And those are the thoughts for this week.